Hello, I hope this finds you well. Happy snowy February of 2021. So, you really couldn't go anywhere last week without hearing something about the GameStop, Reddit, Wall Street, hedge fund short squeeze saga. And because it's such a unique and complicated story, I thought I would not only write a client letter, but also hop on and record a quick video just explaining, what is going on, how did we get here, and what the path forward may look like. So the beginning of this story, believe it or not, actually begins with the COVID-19 pandemic, and specifically the rise of retail trading activity. So over the past year, more retail trading accounts have been opened than ever before, to the tune of 10 million new accounts being opened. And early in the shutdown, you had a combination of people being at home with lots of time on their hands. Betting on major sports was not really an option. On top of that, you had government stimulus checks. And so a lot of retail investors began making aggressive bets on some companies, some stocks that previously had been out of favor. Add to this the increased popularity and accessibility of free app-based trading platforms or brokerage firms like Robinhood, and online forums like Reddit, where members can come together and share information, and you have this perfect storm. Just a note on the free app-based trading platforms: as many members realized last week, they are not actually free. They are the product, and their data is being sold. And so that's why I put free in quotations, because it's not really free. But enter GameStop, or GME. So as a company, both from a business perspective as well as from a stock perspective, GameStop has struggled pretty drastically. They've had to close down about 1,000 outlets since 2019. From 2017 to last summer, their stock price decreased from $25 per share down to $4. And hedge funds began shorting their stock, shorting this company. And what that means is that they were betting that the stock price would decline. Well, a subgroup of Reddit called Wall Street Bets began to realize and take notice that the short interest in GameStop was pretty large. And collectively, many members started basically trying to push the price of GameStop up through these options trading activity. And the strategy worked. It was very successful. So at one point, GameStop stock was up to almost $500 per share. It has since reversed course a bit, but at one point it was up 1,600%. And there were other stocks that were targeted like this, and the strategy was placed on, but this was by far the biggest. So let's talk a little bit about short selling and how that works. So as I mentioned, when an investor shorts a company, their expectation, their hope, their wish is that that price will come down. But the way this actually works is when you short a company, you technically borrow shares from a lender. You sell those shares at whatever the current market price is, hoping the price will go down. If and when it does decline, you buy back those shares at the lower price and you return those shares to the lender. So the way the profit works here is the difference between what you originally sell the shares for and what you buy them back for is the profit. But remember, when we are long a stock or we want the stock to go up, our losses are capped at whatever our original investment was. In short selling, that's not the case, because if you think about it, the stock price, there's no ceiling on how high that price could go, right? It could go up exponentially, and there's no cap there. So it works very differently. So back to GameStop last week, as the stock price was increasing parabolically, these hedge funds that had short positions were obviously noticing. They are looking at their losses go into the billions of dollars now. I mean, we're not talking about a small sum of money. And obviously they panicked. They had to liquidate some of their larger, more well-known companies or stocks to be able to generate cash to cover these shorts. This is the short squeeze that we've all been hearing about. And it's one of the main reasons that last week we saw a basket of stocks that were previously out of favor, companies that were previously out of favor increase, but yet we saw the broad markets like the S&P 500 decrease. So where do we go from here? None of us know exactly how this fascinating story is going to play out, but I think we can look at it from two lenses, from a regulatory perspective as well as a market perspective. My expectation is that there will be some changes to regulations, new rules around retail investing, enhanced disclosures having to come out, maybe even changes to margin or borrowing requirements. I also believe that some of these app-based platforms will have to enhance their technologies because they've been under an immense amount of pressure since we've seen retail trading activity increase over the past year. From a market standpoint, I do think that volatility is probably here to stay for a while, as retail investors have become a larger percentage or component around the daily trading activity that we see. I do believe that will increase or maintain really market volatility. And while there is certainly bubble activity going on in a number of stocks, we don't believe that represents a sign of a large, broad-based market bubble. And remember that the S&P 500 has rallied 72% off the bottom of March of 2020, so perhaps it was just simply time for a pause. But I'm here to remind you that we need to focus on what matters most, on what we can control. We are not day traders, we are long-term investors, and my team and I are deeply grateful for the ability to be of service to you all, for the trust you place in us. So we're here for you. If you have any questions or need anything, please feel free to reach out. In the meantime, take good care.